Hello class, this is your instructor Ron Santos, and this is a tutorial for your balance sheet. And some formulas we're going to be using, some terms you're going to be using are debits and credits. Debits equal credits. It's a balance. We use the equal sign quite a bit. It is fixed. Debit simply means left, credit means right. When we're talking about a T account or a ledger is an example of a T account. We have a debit side and a credit side, which means we'll be making entries to either increase or decrease. Debits are always fixed, always left, credits are always right, but the increase and decrease side can be different. This is the balance sheet formula. Assets equal liabilities plus owner's equity. Again, we have this equal sign, this balance. Assets are everything owned by the business. They're listed by historical cost, and therefore it's not a true evaluation of what the business is worth, but it is a good way of knowing if you've expensed off any large purchases. So anything that you buy, anything that's owned by the business is an asset. They equal is our balance again. Liabilities, what we owe to creditors against those assets. So if we owe any money, we borrowed any money to acquire any of those assets, those would be liabilities. And then the balance is what the owner owns, owner's equity. Sometimes, usually it's the owner's name, Joe Jones Capital it's usually called. Another way of looking at it is assets minus liabilities equals owner's equity. You know, similarly, if you bought a car for $10,000, that would be the asset. If you borrowed $5,000, you would have a $5,000 liability, so therefore your equity in that car would be $5,000. And this is our balance sheet and our balance sheet equation. This is every account that we use is either an asset, a liability, or part of owner's equity. Part of owner's equity, which will be in another tutorial, is also our revenues and expenses, which is our income statement. They're part of owner's equity. And we can see also owner's equity equals assets minus liabilities. In the T account, for assets, assets increase on the debit side. That's what we have here. Assets increase on the debit or left side in this equation. The normal balance, this is the balance of the account. So we would have a beginning balance plus increases to the account minus decreases to the account would equal its normal balance. So it has a normal balance on the debit side, and that is the plus side. Notice liabilities and owner's equity are on the right side or credit side. Their normal balance is a credit. So assets normal balance are debit, or it adds on the debit side, the left side. Liabilities and owner's equity, they increase on the credit side, and they have a credit balance. It's almost like a mirror effect. Okay, so if we're adding a liability, we would be crediting it. If we're adding an asset, we would be debiting it. And we can look at it from a number line perspective. Here's a basic number line where equals is at 0. As we increase to the right, when we go to the right side of the equation, as we increase, we're going to the credit side. Okay, just like here, here's our equal sign. We're increasing on the credit side. When we decrease from here, 4 minus 3 would equal 1. When we're decreasing, we're going to the debit side. And that is also the same here. On the other side of the equation, we have assets. Assets, as they increased on the debit side. Okay, so -1 plus -2 equals -3. So we're adding them as we go to the debit side. And in return, assets on this side, when we're subtracting them, we're subtracting them on the credit side. So I like to think of this number line when we're thinking about assets, liabilities, owner's equity, their normal balances. Okay? The normal balance is variable to either side of the equation, but the debits and credits, those are fixed. It's always left and always right. So we see here, normal balance equals the plus side, it's variable. Assets increase on the debit side, it's one way to remember assets. And then liabilities known as equity are on the opposite. These are T accounts for assets. You'll notice they increase on the debit side, decrease on the credit side. This is a T account for liabilities known as equity. They would normally increase on the credit side, decrease on the debit side, and there's the normal balances. We have an equation for T accounts, and it's beginning balance plus increases minus decreases equal end balance. So we can figure out if we had a question for homework and it was missing one of the variables, we could figure out what it is pretty easily. Here is an asset, cash. This is a liability, accounts payable. And here's owner's equity, which would be a capital account. And we can see that it has a beginning balance. You know, in the business, beginning balance would be 0. We're showing an initial entry from the owner, initial investment. And the owner invested $10. So here's the $10. It's debited into the cash account. Okay? So we either have to credit another asset or credit a liability or an owner's equity. In this case, it's the initial investment, so the whole thing would be owner's equity. There wouldn't have been any liabilities at that time. So here's a journal entry. It's showing the date cash was debited for $10 and owner's capital was credited for $10, and that's going to be for, this is an explanation, investment, initial investment by owner. Notice owner's capital is indented. Okay, debits always go first, so it's here on the debit side, and owner's capital, which is the credit, would go next. So debits always go first, credits always go last, and then we're going to put an explanation in the bottom. Hopefully this T account will help you to understand your balance sheet for Chapter 2. Have a great day, and I will see you in the next tutorial.